The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Again, thank you so much for attending one of the webinars organized by the kind people at investing.com. Hope you can see my screen on full screen mode. Right, my webinar again is my setups for week 16, 2025, which markets I'm trading and why, with using my rules-based trading roadmap. So today's presentation will be about three things. First of all, we will begin with a brief 10,000 feet view of my trading methodology, my trading philosophy. Secondly, I will be having an explanation at a high level again of what the commitment of traders report is. And then I will give you my view for the S&P 500 based on the criteria and the methodology I will be using. So I will be having it first of all as at the theoretical level, and then I'll go in and show you how to practically implement it. I follow this methodology on a weekly basis for to set up my trades. It's very, very systematic and rules based, and I'm hoping to share that with more people going forward, because as I'm setting my own community now. All right, so let's go. First things first, as always, the risk warning. Um, there is a very high degree of risk involved in trading. Past results are not indicative of future returns, and that's most certainly true. And we assume no responsibilities for your trading and investment results, and whether good or bad. And as I mentioned, as I always say, I do not give any kind of recommendation guarantees when it comes to markets, except one, that you will have losses in trading. All right, with that out of the way, again, this is how my presentations usually end. And in order to try to give you incentive for you to stay awake, I will be giving some bonuses to anyone that manages to stay awake. The first bonus will be a paper I wrote in 2022, which was awarded by two professional bodies, the National Association of Active Investment Managers, which organizes and a research competition, global research competition called the Founders Award. It's a competition for best research in financial research on that's on some kind of innovation. And also and I submitted this paper, the MACD Volatility Normalized Momentum, and I won the first award. And also submitted to a similar type of competition, the esteemed Charles Dow Award, by the CMT Association, the largest technical analysis society worldwide. And the paper managed to win first place for both. It was awarded by these two professional bodies. So this is my first bonus for those that managed to stay awake. Secondly, the indicators that were mentioned in the papers have already exactly been hugely acknowledged and also accepted by the community. It's already in Metastock. Stock charts will be put on TradingView, MT4, Optima, and other trading platforms as well. I've already been speaking with wealth charts and many other platforms that will be including it. So again, if you manage to stay awake, and secondly, send me an email, I will include you in that. And also I will be having, sorry, that that's out of date, the 4th of March, obviously it's in April. I'll be having the MACD Momentum Model, the webinar. So again, feel free to send me an email, manage to stay awake, send me an email, and I'll get you all these bonuses. And also a very important announcement regarding my trading community. Okay, so let's begin with the first part of the presentation. As I mentioned, first part is my approach, the general description of my approach, how I merge macros and markets, technical analysis, fundamentals, using a 12-step roadmap to rules-based trading. The second will be at the high-level commitment of trader support, and then we will apply this roadmap on the S&P 500. So if I was to distill my philosophy in three parts, it would be the three basic pillars. The first one would be macros matter. That's the first one. markets go from point A to point B because of fundamentals, not because of technicals. And this is how I view the world. Now, this stair-step looking line is fundamental value. And the other squiggly line is price. So price follows fundamentals. Is sort of like for those that perhaps have a dog, you'll probably understand the analogy. Is like you trying to take your dog out. The dog will oscillate around. You may go, back and forth, sideways, stop to sniff, um, stop at a tree, deviate a bit, but it always be oscillating around you. And this is exactly how markets behave. In this analogy, the dog will be priced and the owner would be fundamental value. So it may go over fundamental value and be overvalued, be below it and be undervalued, become overbought, oversold. So that's my philosophy, that fundamentals drive value. So if you want to see where price is going, you have to understand where fundamentals go. Secondly, multiple time frames. This is a great chart by the great late Ian Notley, also used by my good friend Martin Pring. And it shows that there are in markets there are three operating, at least from my point of view, three operating time frames. At least the ones I use to be more correct, because obviously there are more than that. So the first one is the monthly chart. Sorry, the monthly. Then with this very very thick line. The second one with the black line is the weekly, and then I've got on the daily. So if you come to think of it, so the first pillar I said is macros matter. The second one is you have multiple time frames. So how can you merge these? On one hand, macros mattering, and the other ones, but having more than one time frame. So this is what multiple time frames, multiple factors is, and that is that each time frame has its own macros, its own return drivers. So on the monthly chart, I use the business cycle and economic statistics and various intermarket relationships. This is the big driver. Secondly, on the weekly chart, I use commitment of traders report, sentiments, and seasonals. These are the factors I use for the weekly chart. And then on the daily chart, I go to do my technicals. And the combination of these is what I call multiple time frame, multiple factor approach. Multiple time frames, multiple factors. So these are the two of the pillars I use. Macros matter, multiple time frames, multiple factors. And the third one is rules based. Whatever I do, I always try to be rules based. Very systematic. Now that doesn't mean that I'm fully automated. By my decision making has to be driven by rules. And that takes a lot of weight off of my shoulders in terms of decision making, because my rules are always there to rely upon. And that's something we saw, for example, recently, the volatility we had. As my friend Donald Trump said, make volatility great again. We saw loads of that, and the only way to survive, both financially and emotionally, was to have a rules-based approach, when it will tell you, this is the place to go in, this is the place to get out, and be very rules-based and not get caught up by the huge volatility and emotions created through markets. So again, this is a schematic of being rules based. So let's see for practically, what does rules based and multiple time frames, multiple factors mean? This is the roadmap to rules based trading, smart trading systems. This is one of the two things I offer. One is this roadmap, the course, which of course will be given for free, and also my community. So let's start. Macros, this is the why. Macros is the base of everything. Macros answers the questions why. Why do markets move? Go from point A to point B. Markets move from point A to point B because of fundamentals. And this is checked on the monthly or weekly chart. Then I go into the markets technicals. And technicals answer the question when. When. So if you want to, when should I enter? When should I get out? This is more of when should I avoid getting in, or when should I avoid getting out? Again, these are also aspects that will be answered by technicals, not so much fundamentals. And for this, I've gone to the daily chart, and then macro markets and model. model being the methodology that I use to merge macros and markets into a model, so I can have into create basically get into a trade. The how basically answers the question how do I get in. All right, so let's see this in a bit more detail. So the first thing, as far as macros is concerned, is the intermarket or the business cycle. And I use many indicators and models, and I won't obviously don't have enough time to go through all of this. So this is the first one I'm using. One of the ones, it's a GDP-based recession indicator. Um, and this indicator, as you can see, when it crosses the threshold level of 5, it the squiggly that's the blue line. It indicates a recession. This is based on GDP, and as you can see, as of today, there are no signs of a recession coming in. Of course, there are more models to follow, but I'm just pointing this as an example of how I can, on a very again systematic base, check for recessions, check the big picture, which will tell you whether you should be buying dips or not, or if the market or the economy is headed higher, or we should be looking for worse days than today. So as far as this model is concerned, there is nothing to worry about. So after having checked the intermarket cycle, again, this is not the only model that I would use. I never ever rely just one model, one indicator, but I'm mentioning this as an example of a rules-based approach to the business cycle. The second thing is I check is the commitment of traders report. Now, I'm not sure how many of you are familiar with the commitment of traders report, but I will go through explaining this particular factor. There are, as I mentioned, there are 8 factors I'm watching, 4 fundamental, 4 technical, and I will just briefly dive into this one and perhaps leave the others for a next webinar. Okay, so let's try to go into the commitment of traders report. What is volume? Let's start with volume. Volume is the total amount of contracts, and I'm talking about contracts because today I will be referring to futures trading, futures and options, is the total amount of contracts traded in a day. And this is how it would look like. This is your FX on the top, and at the bottom is volume, the volume you had for that particular day. But what is open interest? What does open interest mean? Well, basically, it means the total amount of contracts held overnight, long and short. Okay? So at the bottom panel, we have that particular number. So for EURFX is more than 800,000, actually approaching 810,000 contracts open interest. That's both futures and options. So that's the total amount of contracts held overnight. So these guys are not interested in closing their positions in the day, but they do have some conviction. So they think that the market will have enough of a directional bias to a particular side, whether long or short, strong enough to hold that. So this is not just an opinion. This is not a report, someone just saying something. These are actually guys who have put their money where their mouth is. So who holds open interest? So that's the $1 million question. Who holds open interest? Obviously, we would say traders and traders with a conviction. Now, are all traders created equal? My point is, no, they're not created equal. So as far as the CFTC, the U.S. regulatory authority is concerned, the CFTC is monitoring the U.S. futures market. All traders are not created equal. So as far as they are concerned, the CFTC, there are large traders and small traders. So who are the large traders and who are the small traders? Now, based on the number of positions they're holding, that's the criteria they use for being large or below that being small. Now that number fluctuates, or it's not doesn't fluctuate. Sorry about that. It's different from market to market. That's why I will refrain from saying if you go like more than 100 contracts, more than 500 contracts, because there are different threshold limits for each market. But let's just call that say whenever you have a number of contracts which is defined by the CFTC, then above that you're a large trader. But large traders are not, even large traders are created the same. So you've got the first category of large traders, because the large trader category is divided in two. The first one is called commercials. The second one is large speculators. So let's see who are, large speculators who are commercials. Large speculators, I'll start with that because that's probably the easiest of the two to explain. Large specs are basically, speculators, hedge funds who are entering the market to, buy high and sell higher, or sell low and sell short low and, buy back lower. So basically, they're into profit from price appreciation or depreciation, and basically speculation. Now, commercials, on the other hand, are not in the business of making money from futures markets. They are in the business of having a legitimate um, business, if you will, and they're using futures markets to hedge that. No, so for example, take a look at the picture here. Coca-Cola. Coca-Cola is producing this soft drink, and part of the ingredients is sugar. So when they have to buy sugar in order to, create the Coca-Cola, at least one of its ingredients, they participate in futures markets to hedge their cost of doing business, because to them, sugar is a cost. Of course, there will be also sugar producers who will be also be participating in futures markets to hedge their production. So basically, from a Coca-Cola point of view, as the price increases, they will be looking to short the market, in order, not so much because they think it will go down, but because they want to be locking in a particular price. So they will be hedging their business, their cost of doing their business, so they can then produce the soft drink at a price which I think they think it makes sense for them. Now, of course, you have commercials who are producers of a commodity, and then you've got users of a commodity. So in this particular example, Coca-Cola is a user, and Silver Spoon might be the Tate and Lyle, actually a company who very well-known company who does a lot of sugar in the UK, might be a company who's the producer, or for example, in energy markets, British Airways, the airline company, will be the user of energy, so they will be participating to hedge their businesses, their books, because in order to sell airplane tickets, one of the costs will be, of course, salaries for their employees, and also fuel. That will also be a big cost of doing business. So as energy markets fluctuate, they will be looking to hedge their cost. And also you'll have refineries and miners who will also be looking to hedge their production. So commercials and speculators are companies who have huge positions in the market, and they are participating, of course, for different reasons. So to be completely, if you want to look at the history, of course, for futures exchanges, markets were created for commercials, not for speculators. They were created as a means to hedge business, and large specs are basically the liquidity providers. And of course, then you've got small speculators, which is, it's just you and I, basically. So what is the commitment of traders report? The commitment of traders report, again, as I mentioned, created by the CFTC, monitors the positions of large specs, small specs, and commercials, and reports it out in this kind of report, when you basically can see how many the commercials are long, how many are short, non-commercials long and short, and you can see there by category, not of course by individual firm, the positions they have. Now, if you graph that, this is what you get. Basically, you see a chart when you've got commercials, you see this is the net commercial position, basically longs minus shorts. And if it is above the zero line, commercials are net long. And if it's below the line, it's net short. That's the first thing to understand. The second thing to understand is as the chart goes up, it means they are accumulating. They are buying and buying and buying and buying up until they capitulate. So they have enough of a big position. And as the line goes down, means that they are short, they're distributing. That's because that's what commercials do: accumulation and distribution. So this is what a very, at a very basic level, the interpretation of this, the line of the position of how much contracts they have, futures and options. So, but why does this matter to us? Okay, let's look at this. As I mentioned, what do? Accumulation and distribution. And these are the turning points that they have done in their accumulation and distribution. So basically, I've noted down, of course, with the benefit of hindsight, the extremes of their accumulation and the extremes of their distribution. So why would this matter to us? Let's switch to price. This is the EURFX. As you can see, when they've reached the point of the maximum point of distribution, market stop. And that is highlighted with a red vertical line. And when they have reached the maximum point of accumulation, markets bottom. And you can see now why markets and tops bottom from a fundamental point of view. These are huge players, and that's how markets turn when they have big positions and they have small positions, big long positions and big short positions. And this is why markets move. Okay, so can they set market bottoms? Yes, they do. Here is another example. Crude oil. This again, marked is the, of course, with the benefit of hindsight, the maximum position they have and how much that creates bottoms. And this is the maximum short position they have and how that creates tops. Now, can we use that information to our advantage? And this is, both longs and shorts. Yes, we have. But before that, let's look at small speculators. And this is small speculator position, and you can see, it's, basically they're the rule of 90, what we say, the 90% of traders losing 90% of their capital within 90 days. Well, this is why you can see they have maximum position when at tops, and the worst, the fewest, the smallest amount at market bottoms, and they're really, it's basically they're the opposite of what people should be doing. Okay, so let's look at the rules-based system for this, how we can create that. I created a system how to basically decipher on a real-time basis what commercials do. Basically, on similar to the examples I showed you previously, this is the system I have for the S&P 500. And what you see here, let me try to explain to you. You have big arrows and small arrows. Now, the big ones are what I call major signals, alerts, and the other ones are minor, usually, and then the bars are color coded as long as these signals are valid. So the first thing to remember is these signals are on the weekly chart. So when you see here 5, 6, 7 bars, that is actually 5, 6, 7 weeks. So these are big positions. The second thing you have to understand is that this is again, being on the weekly chart, this is not an automated signal generation system. These are alerts. What I do is once I have that, I go to the daily chart to get signals. So this is my setup tool. So my work begins first on the weekly chart, waiting for one of the factors, as we shall see later on, which are the other ones. Already we've seen two. One is the business cycle. Now we look at the commitment of the red report. And when these line up, then I go to the daily chart. So my work begins with macro. There is almost no technical analysis here. It's all macro. And then I go to the daily chart. So for now, I go buy a minor buy signal on the S&P 500. Again, I don't monitor just one market, one asset class from the four asset classes, FX, bonds, commodities, and of course equity indices. I monitor all markets that have CFTC, the COT data, and I look for setups across all these asset classes. Okay, so now we know that we have a minor buy alert on the S&P 500 as of the close of last week. So what is the next step? Sentiment. Again, sentiment is a very, very big factor because it's inversely related to liquidity, because the more people are invested in a particular position, the less available cash they will have. So sentiment is a very, very big driving factor. One of the four major ones I look at from a macro point of view. So this is my indicator called the S.M.A.R.T sentiment composite, and it's a composite because it's comprised of different indicators to give me a composite reading. Again, this is the composite indicator, color coding the market based on if the sentiment is bullish or if the sentiment is bearish. And when it comes to the critical levels of greed and fear, greed, being too much positive sentiment or too much fear, then it's color coded as blue. And as you can see, we had some fear indications for the S&P 500 based on the composite sentiment indicator, meaning that we could be prone to see a sizable rally. Again, I've also left these arrows are from the commitment of trade report. Again, this is a setup tool. So what I do is I check out the chart on the weekly and then go to the daily. So my commitment of trade report is bullish, sentiment is bullish. So it looks like this could be ripe for a rally, and I could go in on the daily chart, of course. But this, of course, the composite sentiment indicator is not the only one I look at. I've got other ones as well, which have not been placed in the composite. For example, like breadth. One would be the percent of stocks above the 50 bar moving average. And this is an indicator which basically checks all the constituent stocks of the S&P 500 and looks how many of them are above the 50 bar moving average, and look and then how many are below it. And when it reaches below the threshold of 25, then it becomes oversold. So basically what this says is that 75% of the 500, actually it's more than 500 stocks in the S&P 500 are below the 50 bar moving average, and this is by historical standards oversold. Now, of course, there's nothing magic about the 50 bar moving average, and we can look at a more long-term view by looking at the percent of stocks above the 200 bar moving average. Again, this is also showing signs of a market that is oversold, at least in the short term. So I would not be surprised if we have a good sizable rally from these levels. So far, commitment of traders report, sentiment, breadth, everything looks like it's conducive to a rally from here. Again, this is all step by step, rules-based macros and markets merging together. So what's the last thing we look at? Seasonals. So again, these are my macros. These tell me what bias I should have. There's no, as you noticed, there's no technical analysis tools on the chart as of yet. So the seasonals, again, this is how the S&P 500 looks like, and at the bar below, the indicator below is my seasonal index. The market by historical standards, I mean, if it's did what it should do in the past, it should have topped sometime on the 14th of February, a bottom around the 24th of March, and then rally up until the 13th of August. Of course, seasonality is not written in stone. It's just a historical depiction of what usually happens by market behavior. And we should always not take it blindly, but basically compare it versus what the market should be doing, as depicted by the seasonality, versus what the market is actually doing. So now that we've got all that factors and which all point to a positive view, let's go to the do some technical analysis. And as I mentioned, these are my core indicators. There are a lot more for each category of for each, for intermarkets, for commitment traders, sentiment, seasonals, but I'm just showing at a high level how approach markets. So then go to the technical. So the first factor I look at is the trend roadmap, the trend market map. So as we all know, markets are, have a trend. It can be bullish, it can be bearish, but that's not enough, at least not from my point of view. You have 4 stages in a bullish stage and four bearish ones. So let's look at these. It's like a trend life cycle model. So markets, again, as I mentioned, they're bullish, they're bearish, but as you can see from the sine wave, a bullish market has an up leg and then a down leg. So this is an emerging bull market. When the market has entered the bull market, but it's not mature enough. Then you've got an established bull market, and then you've got counter trend reactions within the realms of a bull market. So it's still a bullish market, but it's having a correction. So you have a bull market dip and then a more significant bull market direction. So not just enough for me to say, oh, we are bullish or we are bearish. That's binary, because there are shades of gray in between. Likewise with bear markets. You've got an emerging bear market, I mean, a market that has just entered, the classification of being a bear market. And then you've got an established, oops, that should be bear market, guys and gals. So apologies for that. I should be correcting the point per representation. So number 6, it should be established bear market. And then you've got obviously counter trend reactions, which of course is like a short-term bounce or a bear market rally, a more significant rally. So these are the 8 stages, and these are extremely useful in defining the trend and also aligning ourselves with the trend to take the appropriate trades. So this is how it looks like. Again, these are color coded. If you see the arrows, it's green, dark green, yellow, orange, brown, and then red. And then you've got light blue and dark blue. So this is how I've color coded it in real time. So it can help me identify these stages. So the market currently is at stage 7, having a bounce because it through this short-term, so this decline, it had the short-term definition of stage number 6, and then it immediately bounced back. So this is the stage that the S&P 500 is currently in, and this is very, very useful model for 2 reasons. First of all, on the S&P 500, or let's say in the market you're checking, in this particular example is the S&P 500, it will let me decide whether I should be taking buy or sell signals. So let's go back to this chart. Buy signals, I will only take, again, on a rules-based fashion in stage 1, 2, 7, and 8. So when the market has a trend, obviously, the more established the trend, the less risk it has. So stage 2 is the best, the safest, if you will. Stage 1 is the second, stage 8 is the third, and stage 7 is the least. Okay. Likewise with short signals, stage 6 is the best, then 5, then 4, then 3. But I will never ever take short signals against the trend. Okay, so this is where the trend is. Another way for me to define the trend is what I call the S.M.A.R.T 200 bar moving average. Now, this is again 200 bar moving average, and most people say, okay, if it's above it, it's bullish. If it's below, it's bearish. But again, that wasn't enough for me, so I had to distinguish between, counter trend reactions because prices were sometimes rising above the 200 moving average and they were falling behind the moving average. So I've color coded it in this fashion. So if it's above and rising, green; if it's above and falling, it's yellow. And likewise, when it's having counter trend reactions, below it. So the safest place to take buy signals when it's above it in green. Now there are exceptions and rules when you can buy when it's above it in yellow, and that will come later with the MACD when it's truly oversold. You can speculate a bit, but Unless that happens, you're better off taking buy signals when it's above and green. So now that we've got at the high level the trend rule map, then I'm going to mark the relative ranker. Now, what is relative ranker? That is a measure for me, a way for me to establish why, so which market is the best to trade from a strength point of view. Let me give it via an analogy. Let me go back a few slides. All right, so this is the market map. Imagine, not imagine, you don't, having a large universe of markets that you're trading. So for example, let's say you have 50 or 60 markets. When you classify these across these 8 stages, some of them will go in stage 1, some will go in stage 2, some will go in stage 3, 4, and so on and so forth. So imagine in stage 4, you've got, say, 10 markets or 15 markets. They will not all have the same strength. If you think of trend like direction, like being in a car, and say some cars will be driving north, bull market, or some cars will be driving south, a bear market, the distance will be dictated by relative strength. So direction will be a market going from, no, I live in England, say a market goes, some car drives from London to north to Manchester. That's the trend. But where you are within this, between London and North Manchester, is the relative strength. So if you were sitting in a car, your dashboard, that would be the odometer. All right. So that would be the odometer. So this is what relative strength is. So the odometer would be this. Again, the strongest markets. Basically, for my relative ranker, anything above 150, 150 is really strong markets. So the strongest currently, at least from my universe, and you can check any, of course, with these tools, you can check all the markets that you are interested in, is gold, feeder cattle, ducks, live cattle, Hang Seng, natural gas, and these are the really, really strongest markets right now. So if you are fundamentally and technically bullish, so for example, your bullish equities, so which equity market should I trade? Because there may be 5 or 6 different indices you're watching. For example, you might be watching the S&P 500, you might be watching NASDAQ, the DAX, FTSE, Eurostox. So which one should I do? If you're bullish with for the same asset class, relative ranker will be your tiebreaker. It will tell you which market is best to trade, both on the long and on the short sides. And these are the relative ranker stars. Now, you've got the ones in between 150, and then you've got the ones below, which is the ones that I've got for below, lower, smaller than minus 150. So these are the weekends. So if you wanted to short markets, considering that the fundamentals and the technicals were saying do that, these were the guys to short. So where is the S&P 500 here? That's where it is, right in the middle. All right. So this is one of the tools I use. Strongest versus weakest. So if someone wants to, of course, say, okay, how much difference does it make? Let's take at the difference. Let's see the difference between the strongest, gold, and the weakest, which is OJ, orange juice. Strongest versus weakest. This is how it looks like. And now you see why relative ranker is such a great tool. So from the point of 17th of December, when relative strength or comparative strength between these two markets, you can see how the one has been rallying since the beginning of the year, and OJ has actually been crashing. So imagine being long the first market, and imagine being short or along the OJ. You definitely big different risk profile, trend profile there. So you're much better off following relative strength markets on the long side for strength and on the for weakness on the short side. So this is the second of the technical tools I check. And then I've got the MACD model. This is my brainchild, if you will. All right, so in this chart again, I've got the S&P 500. On the bottom below is the market map, color coded, the dashboard with the stages 1 through 8. The bars are color coded based on the market map model. So what you're seeing on the top part of the chart, the color coding of the bars, is the same as the script below. In the middle, I've got the MACD, the volatility normalized momentum. Again, if someone is not familiar with my work on the MACD, please feel free to send me an email and I will send you all the information about it. So what do we have here? What I've got highlighted here is 1, 2, 3, 4, 5, 6, 7, 8 instances where the MACD got below what I call the rundown range. There are 7 ranges in the MACD, and what we see here is the last 8 occurrences that the MACD got on the rundown range, and the market rallied in all 8 of them. Now, we also had some kind of divergence before actually this fall. So from a momentum point of view, we had quite a big of a heads up that there was something wrong with the market. So for those that are news trading, talking about tariffs and things, and of course the market reacted to the news, but from my point of view, the market was weak anyway. So it would have it just needed a bad news item, which of course the indecision caused by the tariffs provided the excuse, or basically the flame for the fire to light, but there was already gas on the floor, at least from where I'm coming from, both from a commitment trader point of view, because if you remember on the second factor we looked at, we had some sell signals based on the commitment of traders report, we had divergences, there were other signals, so there was already fuel on the floor. So just someone threw the match and the market fell. So now we're back at the range that has produced meaningful rallies in the past. Rebounding range right now, as the started rebounding actually. Rundown range is when it's between minus 15, minus 150 and falling, and the rebounding range, which is again minus 50, but it's and rising. So 8 at the last times it produces a tradable rally. Now, this is not a prediction that the market cannot, continue falling, but as far as the here and now is concerned, the trend has changed and we are at the rebounding range. So it looks more likely to rally rather than fall. And this is the last of the technical factors I look at, volatility valuation index. Again, this is one of my own brainchilds. It basically gauges what is the volatility of the market. And as you can see, I'm using different factors to gauge the market, and I'm trying to see if they're uncorrelated, because one of the mistakes, and it truly is a rookie mistake, when people first of all don't look at fundamentals. And okay, so if you want to say I want to be strictly a technical trader, fine by me, but at least you have to be seeing the technicals using different tools, not from different categories, different factors. For example, a rookie mistake when I see someone charting, plotting the RSI, and they've got the stochastics, and then you've got the MACD or MACDV, and they're using same tools, or 5 different moving averages on the chart to gauge the trend, or 3-4 volume oscillators. Guys, these are just the same tool, singing the same song. You need different different tools that look at different things to look at the market from a different viewpoint. So let's look at the market from a volatility valuation index. Again, this is proprietary work. Now, the chart at the bottom, again, the volatility valuation index. And when volatility is very, very high, above the 130 range, the trends reverse, and I won't say and this is completely different to overbought and oversold. This is a very unique indicator because high volatility can happen both at tops and bottoms. When you've got high volatility and it is rising, the market is looking to fall. When it is high volatility and falling, then the market will be looking to rise. So this tool is trend agnostic. Huh? Trend agnostic. For equities, most of the times, not always, most of the times, high volatility is usually, again, not always, with bottoms. For commodities, it's the opposite. Usually, tops are high volatility events. So if you plot this indicator and study it across chart, you'll see that both bottoms and tops occur. The difference is that you have to be seeing what's the prevalent trend there and try to look for signs of reversal. So again, this is the 1, 2, 3, 4, 5, 6, 7, 8, eighth time that's reached an extreme, and you can see how the market volatility at this was so high that then, as depicted by the indicator, is starting looking to reverse. So another tool we have now. One of the benefits of this indicator is that it's freely range. It's not range bound. So as the markets fall and as volatility decreases, and that's what I really love about it, it's not bound to a 0 to 100 scale. And that's, for example, indicators like the stochastics, the RSI, and so on and so forth. Basically, anything that's got 0 to 100 scaling, I really don't like. I'm not saying that it's not useful. It's range bound, so it has a cap to the upside and the downside. And something that I explained on the MACTV webinar. So again, if you contact me, I'll show you exactly what I mean. So using this indicator, it looks like the market is again reached some kind of a capitulation based on the volatility. Now, if the market, of course, has a bounce, reverses, volatility could make higher highs. We've seen that happen before. But using our rules, we will know exactly what to do. The market reverses, changes trend stage from 7, say, to 6. That's a no for us to be buying. We will not be buying at stage 6. We will wait for the market to turn a bit, volatility to signal a reversal, and then starts buying. So again, being rules-based. And you don't have to forecast with rules-based trading. All you have to do is identify, and that's one of the things I love about rules-based trading. And the using my favorite expression, what will the market do? I don't know. Just follow the rules. Follow the rules or follow the fools. This is a dual view of the market, both of the MACD and the volatility valuation index, because a lot of people will be asking, okay, so what's the correlation between these two indicators? And this is, again, quite unique. As you can see, now in blue, I've got the turning points for the VVI, the volatility valuation index. In green and red, I've got the reversals for the MACD. And as you can see, the main turning points, in a lot of them, both tools spoke, both the VVI and the MACD. Now, what's really unique about it is that these indicators are not correlated, because if you plotted the MACD and the RSI, they will be rising and falling in tandem. Now, these are completely different. For example, look at the decline we had in July, late July to August. Sorry, early August 2024. You can see it in the roughly in the middle of the chart. So you've got one green line depicted the low for the MACD, and then you've got right next to it a blue line which depicts the high for the VVI. So both indicators spoke, but one was at the high, one was at the low. So you can see they were not correlated. You're not just plotting the RSI here and they say, oh, both go up, both go down. Again, in the March period, the VVI was at a high, the MACD was at a low. Same thing in April, the MACD was at a high, or at a low, and the VVI was at a high. Now, sometimes they don't always speak. So, for example, on the 22nd of April, the VVI was at a high, the MACD hadn't reached its low. It does so later. Or on the 12th of March 2024, the VVI was at a high, the MACD was not at an extreme. 4th of December. Again, the MACD got at the risk range, and so on and so forth. And you can see how you can see the market from a dual point of view, both volatility and momentum. So now that we've finished, both the macro and the technical view, these are my core indicators. I've got more in each category. Could try to see things from a slightly point of view, or create composite. That's why I create composite models. So and that's how I view markets, analyze them, again in a rules-based way. So the next step is to form a strategy, because if we stop here, we'll just be analysts, we won't be traders. And in order to create a strategy, you've got 4 different steps. Again, 4 steps. The 4S framework: setup, signal, stop, and size. So setup is basically the directional bias. Should I be looking to go long or short? The setup is dictated by the macros and the technicals. So when the macros say we're bullish, that bullishness has translated into a positive bullish stage in the trend roadmap. So that's the next step. Then look at the relative ranker, MACD, and then we go into the signal. Now, each week I set all the setups I have for my market, because right now I'm just doing for the S&P 500. But as I mentioned, I check about 60 more than 60 markets. So obviously there will be a lot of setups, some better than others, and some a bit more risky. And I publish this in I'll start publishing this in my community. So today I'll be showing just the S&P 500. If you're interested in more of these trade setups, again, feel free to contact me. And the next step, as I mentioned, is signals. So let's say we have, as we mentioned, we have a setup market. So how do I use signals? So these are the signal generating algo I've got, the system. Now it's got, as you can see, both short and buy signals. These signals are not, repeat, are not to be taken blindly. These signals are there to be taken only when you have the market set up. So when a market is set up in a bullish, you've got a bullish setup, the technicals dictate that you give you a green light, you will only be taking buy signals. Now in this chart, just for the sake of completeness, I've got both buy and short signals. Now, because I think the market is more likely to go up than down, I will not be plotting short signals on my chart, just buy signals. All right. So here I've got buy and sell signals, but these do not respond to how you should be trading. I've just got them so you can, get a glimpse of that. It works both ways. And then obviously if you got stops, then I'll be pricing stops, and then size, which is the size depends on how bullish or bearish I am on a particular trade. There's a framework for different sizing algos. Again, these are the attendance bonuses for those that manage to stay awake. I'm not sure if you've got any questions. If not, I would like to thank you very much. So I can thank you very much for your for attending this webinar organized by investing.com. I will be very much looking forward to speak to you, and I hope you manage the volatility, don't get sidetracked, and you get the using a rules-based framework to have some discipline and confidence. And with that, I would like to thank you all very much for having attended this webinar, and hopefully I will see you again soon, and wish you a very happy Easter.